I'm Ellis Martin, and this is Money Talk Radio and the Ellis Martin Report. Join me for a conversation now with Gary Hanna, president of Prairie Operating Company, trading on the NASDAQ as PROP. That symbol again, PROP. With decades of leadership in oil and gas, Gary has guided Prairie through expansion in Colorado's DJ Basin, positioning the company for strong growth. Gary, welcome to the program. It's great to visit with you today.
Thank you very much. Appreciate your having me.
You've had a long career in oil and gas leadership. What first drew you into the industry, and what lessons have shaped your approach today?
I actually started in the early 80s, and then when I was getting out of university and energy was just super hot, and being from Oklahoma and graduating from the University of Oklahoma, there was a lot of focus there on it. I had a lot of experience working in the land side of it and working my way through college, so I've naturally drawn into it. So it was a pretty easy thing. When I got out of school, I started a company on my own and built that up and never looked back.
What kind of lessons have you taken along the way?
This business, you really need to roll with the punches. It's probably true in a lot of industries, but being a commodity, we're very cyclical. It's a lot of ups and downs in our business, and if you can manage those cycles and work your way through those cycles, watch your debt through those cycles, take some dollars off the board when you're in the high side of those cycles, it works very well. That's probably the biggest takeaway I've had. I've learned a ton along the way, mostly about people, capital markets, et cetera. That just goes with the turf. But I think just from the life lessons is we're in a business that can be sometimes subject to political influence, all kinds of environmental influences, et cetera. And you have to be prepared for those and run your company accordingly. I think that's the big takeaway.
Sounds like a lot of potential hostility coming from all directions, actually.
It can be. It can be. I'm sure there's people in other industries that argue the same thing.
I don't think what people understand that are against oil and gas is that everything that we basically use is a product of oil, and to do without that, you might as well walk around in a burlap sack.
Yeah, that's a fact. As well as I do, that the world runs on hydrocarbons, and it's across the board. The plastics, medicines, on and on. The clothes we wear, everything is around hydrocarbons. I just don't think people realize that. They think it just fuels your car. I don't think they really understand the hydrocarbons really create electricity. So they go to their thing, they light their light switch, and they think, oh, this is magic. The majority of that's driven by hydrocarbons, primarily natural gas. So I think without it, we would be in a heap of trouble and lost as a society without it.
Oil and gas prices have always been very volatile. Here in California, a gallon of gas is between $5 and $6 now. The rest of the country, it's $3 to $4, which is still what people consider high now. If you bring down energy cost to attempt to fight inflation, you're really not helping the oil and gas industry per se. So how do you balance all that?
Yeah, if you look at the price of a barrel of oil today, and as we sit here, it's low 60s, say. And on an inflation-adjusted basis, relative to 20 years ago, it's sub 40. So it's surprisingly low right now. And obviously, there's a lot of forces that try to drive that down. The government obviously wants to keep inflation down and so forth. It's really a supply and demand issue and a perception issue, I think, Ellis, that in our point of view with supplies today, where they are, the types of wells we're drilling now, I think a lot of the type rock has been developed and utilized. I think we're really maxing out in the United States as far as resource plays go, and we're for the most part throughout resource plays. This is true in the Permian, it's true in the DJ where we produce. We are drilling not super A rock, we're drilling B rock, I call it. And the trick to B rock is to watch your cost and adjust things so you can make B rock perform economically like A rock. Oil is super cheap right now. We think there's a super cycle coming, maybe as soon as the fourth quarter or so of next year, and maybe a little bit beyond that. But you can't have the demand increases we're seeing today with supplies generally low. We don't think the world has the ability to react to that supply demand. So if you look at what's going on in third world countries, you know this story well. Most of the world lives on their energy weak, and there's a lot of energy poverty around the world. Majority of people still burn either pig dung or burn wood in their homes. Environmentally, it's a mess. Health-wise, it's horrible. Life expectancy rates in those countries are extremely low. They want to make this transition. They cannot afford to have solar powered or windmills or so forth and so on. They're going to go to the cheapest source, and that cheapest source today is usually starts with coal, works its way up through hydrocarbons. So there's a lot of demand and push in the third world side. And then domestically in the U.S. and around the European markets, you can see what's going on with AI, the demand around data centers. And if you look at the growth rate, the projections there is stunning. It's stunning amount of power that's going to be required. We can talk about this for hours because the power grid alone is a problem. I don't think they can actually get power to these data centers, but it's going to take a tremendous amount of energy to do that. We think that hydrocarbons is going to fill that void. There's no way that renewables, they can certainly say supplement hydrocarbons, but I don't think there's any way in the world that they could ever possibly keep up, much less replace hydrocarbons in the world going forward. So as that demand increases, we don't think there's any choice really but to see prices around and certainly in WTI and US, but also around the world go up. We can make money at $60. We'd make a lot more at 80. It can get too high, I believe, where it's damaging to the economy and actually erodes demand. But I think there's a lot of room for us to run between $70 to $80, $90 a barrel. I think that's where it's going.
So what I heard you say is 60 is the new 40, right?
Yeah, it really is. Yeah.
Now, you mentioned data centers. We've got a sponsor company in the Roswell area that's going to be supplying natural gas to a large data center over there. This is a thing. The data centers cannot really exist without fossil fuel. In Colorado, is there any proximity to that with the DJ Basin at all? There's a lot of tech in Colorado. Have you had any conversations with those folks?
We've had conversations with folks that are actually thinking about building data centers here, at least on paper today, ready to go. To me, I think you're seeing a lot more of that in places that are maybe a little more friendly than they are in Colorado. That's not the world I live in, so there may be people with things on paper to go do that. But you have two problems with those data centers. It's the incredible amount of energy that it takes to do it. It's being able to supply that in a consistent manner. Again, the problem with solar and wind, sometimes the sun doesn't shine, sometimes the wind doesn't blow, and they need a constant power supply and battery backup systems and everything else in the world. And the amount of water that they use is stunning as well. So they have to be around a pretty steady water source. Water's a big deal in Colorado. So I think that may be one of the stifling factors about developing those in Colorado is the amount of water that they use. And I don't think people really realize that, but it's millions of gallons a year. We haven't. It's maybe something that we work on in the future. I think the ultimate answer to the power problem around data centers lies more in getting small nuclear reactors, I think is probably the way to go once we can work through all of the environmental and regulatory issues around that. But that technology has moved a great deal over the last 10 years. They need to solve some problems with uranium supplies and so forth and so on, but they're very manageable, they're very safe, and that's probably ultimately the answer, but we got to be 10 or 15 years at best out on that.
So oil and gas will be relevant for quite some time. I don't ever see it go away. Let's talk about the DJ Basin, and in that, hydrocarbons into the atmosphere. You have found a way to basically minimize that in an area where there's probably a lot of cattle doing their own thing anyway in that regard.
Yeah, it's pretty much a known fact that for starters, we're primarily in Weld County, which is a huge county in northern Colorado. I think it's the size of Connecticut or something. It's absolutely monstrous. But it's the number one oil and gas producing county in the state. So it supplies an incredible amount of revenue from a tax standpoint. And it's also the number one agriculture county in the States. That is all supplemented by the dairy industry, which is giant there. So yeah, a lot of cows, they produce much more methane than the oil and gas industry does in Weld County. It's kind of a known fact. It's a running joke up here, but they got to figure out a way to manage cows. I don't know. That's not my business. But in our business, we think we produce the cleanest, lowest carbon footprint molecule of hydrocarbons in the world. We believe this is true. And it's over a couple of reasons. One is we do not flare. Everything we do goes to pipe. So all of our gas, everything else, Texas, for instance, when I was in the Midland Basin, and not too many years ago, we flared a lot. You can see it from outer space, literally, Ellis. We don't flare at all, so that greatly cuts back on it. Electrification is a big driver for us. So we've contracted for a lot of megawatts of power in order to bring that power to our pads and run our pads off of electric power versus running diesel generators or something else that would emit pollutants into the atmosphere. So that's effectively been eliminated. When we do use any kind of source to do that, we use CNG to power generators, which is much cleaner to burn. So our footprint, just as far as that goes, and we really aggressively manage the transportation systems out there. So as long as you're not trucking a lot of oil or you're running a lot of trucks up and down the road, your carbon footprint is greatly lowered by low amount of truck traffic that we create in the county. So I think the combination of those things, along with a lot of other practices that we do of controlling emissions around it, we could talk about it for hours, but You've been out to our facilities out in the field. You can't smell anything. They're very clean. They really don't emit anything. And we're very conscious of that. We monitor it constantly, and our emissions are incredibly low, incredibly low.
I was just going to comment on that. I didn't smell a thing when I was out there, which is surprising because even here in California, New Mexico, other parts of the country, it just reeks everywhere. And there's none of that in the DJ Basin.
No, it's extremely clean. We rarely, if ever, get a complaint from folks out there. One of the reasons we like rural Weld County, Ellis, is because the amount of people there is very low. We drill in locations where often it's a mile or two before a farmhouse comes into play. We like that in that it's very easy to manage around it, because when we do drill oil and gas wells or frack oil and gas wells, it can be a little noisy, and we go to a lot of trouble to control our noise footprint as well. Sound reduction walls, all kinds of technology that we use, muffler systems on engines. Working in rural Weld County is great for that, but I can't remember ever getting a complaint about any kind of an odor. And if it did, it'd be some kind of a malfunction. We're very careful around that, and it's a super clean organization.
Speaking of Weld County, you exercised your option, Prairie exercised your option to acquire the Exoc assets in the county last year. What was the strategic thinking behind the deal, and how does that fit into your growth plan?
Yeah, that's a great question. We closed the Exoc acreage acquisition, which was 27,000 gross acres or something close to that. It was the original deal that Ed Kovalik and I did when we founded the company. Within a year or so, we acted on our first tranche of acquiring Exoc assets. We were still putting things together, so we decided to close that in tranches. That last option was the final tranche of that you probably saw. So it was just a culmination of an acquisition that we had planned to do all the way along. We believe that there's a lot of running room organically, and we can talk about some of the acquisitions we've done over the last 2 years or so, and growing from 2,000 to 25,000 barrels of oil a day, barrel of oil equivalent, pretty rapid. But a big chunk of that, and the driver on that, is the organic side of it, not just in A&D and acquiring assets, but it's in developing our own. This acreage is critical to us to have that running room to be able to grow our assets organically. And that's what we can do with the drill bit. So right now we're contracted with a full-time rig. We drill wells very quickly here. It's very unique. It's so much different than the Permian or a lot of other basins around the world. Offshore, I don't care where you go around the world. We drill a well in about 4.5 days. And for a 2-mile lateral, that is stunningly fast. So the technology that we use and being able to drill and keep that bit square on the line, east, west, north, south, downhole bit technology, going that quickly is incredible. The technology is just amazing. So we can drill these very fast. So a single rig, we can drill 60 wells a year, and our frac program's right behind it. So it just follows the rig around. So we can drill a lot of wells in a year. So that's very unique, and we're contracted to do that now. But that acreage, in your original question, why do we need that? We are still growing acreage. I think we're up to 60,000 acres now. We intend to keep growing that organically. Those leases are our lifeblood to the future, and we try to keep a 10-year inventory up to 500-600 well locations in our inventory at any given time that we can permit over the course of a year. Keep those permits out ahead of us. They run for a couple of years. You don't want to overrun it, but that's just a steady cadence that we can do at that 60 wells a year. That acreage is super important to us to be able to drill at that pace.
It's pretty competitive there in the DJ Basin. What makes you different from your peers? Are they really competitors, or are they friendly people?
Yeah, for the most part, else they're friendly people. It's a relatively small community here in Colorado. Nearly everybody's locally based out of Denver. We have sub-operations, of course, up in Weld and out of the town of Greeley. There's a lot less players than there were before. You know that over the last 10 or 12 years, there's been a lot of consolidation. We've seen that. A lot of that consolidation in those companies, Civitas, some of the bigger ons that come to mind, PDC sold to Chevron, et cetera. So our big guy competitors out here are Chevron and Oxy. And then you have a series of, I would say, 6 to 8 or 9 smaller companies. Most of those are private. There's very few public entities here that compete with us. But for the most part, they run in their lane. We run in ours. We don't come across. Acreage swaps are common. So all in, it's very friendly, and it's small enough that it's manageable. Moving Chevron and Oxy are their battleships, so they take a while. But we think there's a lot of work to do with them. They own so much acreage, and their ability to get to it, even in their size, we can reach those assets much quicker with permitted well slots that we already have, and we can drill into some of their acreage that we combine with ours to form drilling and spacing units. So we think there's a lot of farm out potential to do with Oxy and Chevron. They're open to this. We have constant dialogues with them about projects that we're working on, but they look at our cost structure relative to theirs, our takeaway capacity that we have contracted, our ability to manage produced water because we control our own saltwater disposal systems, things that even them at their size do not have, at least in that particular area. We think there's a lot of future working with those companies. And then the smaller guys, of course, we talk to them weekly and do swaps and try to cooperate as well as we can to coexist out here. So it's a good environment to work in.
What's the M&A environment like compared to other parts of the resource sector? Do the majors look at companies like yours, or is that just not in your playbook?
Oh, they could at some point in time. Our goal, and I think in prior conversations that you've had with Eddie, probably mentioned this too, our goal is to be a 100,000 barrel a day company. At that size, we've got a lot of mass. I always tell people we don't build our companies to sell them. That's not our driver. But it often happens. And it's going back to those cycles I was talking about. So if you look at my history over the 5 or 6 larger companies that I built either from scratch or brought out of bankruptcy and cleaned up the balance sheet, relisted them, and then built them and sold them, I didn't build any of those with the intent to sell, but oil gets up to $110, $12 a barrel. The last one, the big one I sold was a 12 multiple. Think about it. So I'm doing my shareholders a disservice if I don't sell that company at a 12 times EBITDA multiples. You get forced into cashing your chips in by pressure of the markets, but that's not our intent. The big guys we're too small for them. I think that prior acquisitions they've done like PDC and some of those were fairly large companies. I think Civitas to some degree got left at the altar. They were the other company that had the scale that would be attractive to a major. We'll get there, and that may be something that they're interested in at the time, but there's no way to predict that. There's no other companies here that are that big. I think it would be my guess would be somebody out of Basin coming in and liking our cash flow models and liking our long lived reserves and those kinds of things, and to enhance their balance sheets. I think that's the obvious acquire if there was one. But I think we're years out from that else.
We've spoken with CEO Ed Kovalik, who you mentioned, and also CFO Greg Patton. Like yourself, geniuses in their own right. The team that you have here is extremely unique and interconnected. Can you elaborate on that for just a couple of minutes?
Sure, I can. We've got some really bright guys around us. And sometimes I feel like the old guy at the table because some of those kids can run circles around me. They're absolutely brilliant and fast. So I try to do my best to keep up. But we've gone from really about 4 or 5 core employees that we had back when we did the Exoc work and we started building the company. We're up to 60 plus now. So in that interim, we've accomplished a tremendous amount and added on very strategically people at particular skill sets that we need, whether that's like in Greg's case, finance and accounting. He's got a really good understanding of the markets for vendors and products. He's been in the basin a long time. That experience is very helpful. Most of the people that we have here, if not all, have worked in the DJ for some time, and they come from Chevron. They come from PDC. They come from companies like Great Western, where Greg came from. So we've cherry-picked and assembled a group of people across disciplines I believe are highly scalable. I think we can grow a lot with the group that we have, a tremendous amount of skill. And in this interim period over this last 2 years, as we've grown, as we've executed these acquisitions, as we've integrated these, we've accomplished a lot of other things with these skill sets. So we've developed a very extensive geologic and petrochemical knowledge through the basin, especially in our area of Weld County, which is more in the oil window. We have developed software products, an ERP kind of a strategy around integrating all of our departments. So whether that's information coming in the field in real time, it all gets integrated into a system. That was very painful and difficult to put into place. Fortunately, we had the skilled people around to execute that. That is all now in place. Again, highly scalable. We went overboard on it a little bit because we knew we could grow into that package, but it's very robust and it's something that we've accomplished, but we wouldn't have been able to do that without the talent that we have around us. Our pipeline system that we've developed, our takeaway capacity, both in water produced, oil produced, and gas produced, the intricate contracts that we've been able to put together over the last 2 years is amazing to me. It's an incredible amount of skill and knowledge at the basin, and it's with probably 6 different parties, Ellis, so it was fairly complex to do, but it literally guarantees us takeaway capacity up to 100,000 barrels of oil a day. It's a very unique capacity to have in our area of the basin. And it's a big driver why we can do deals with people, because we can come in, we actually drill cheaper. It's one of the kind of advantages I think we have is our drill costs. Industry right now standards probably pushing up against $6 million. It'll be 5.8 to 7, depending on who it is. We've got that number down consistently to about 5.2 for standard 2-mile lateral. That is pretty doggone competitive. And we, as I mentioned before, we are drilling rock. And one of the ways you make B rock, A rock is by managing your cost. I say this all the time and it shocks people, I think. We are not in the oil and gas exploration business. We are in the oil and gas extraction and production business. It is like a factory. We don't have a great deal of geological risk. We don't have a lot of different kinds of risks that you would find when I operated in the Gulf of Mexico, for instance. So it's around controlling your cost on a per barrel basis and then managing your lease operating expenses to get those down as effectively as you can. And when you do that, your competitive advantage is tremendous out here, especially at $60 oil or $55 oil or what may be, whatever it is. We think we can produce profitably down into the 40s, probably the low 40s. But after that, we're just not going to drill wells at $42. Why burn your inventory at those kinds of rates? We can simply pull back a little bit and just ride that little storm out. We're very aggressive in our hedging. We're about 80% or so hedged on our proved developed producing assets right now through 2028. And we constantly roll in new hedges. So we're not in the commodity betting business. That's not the business we're in either. You can do that at your computer all by yourself. You don't need us to bet commodity prices. You need us to be very efficient and safe in what we do and produce a very clean molecule of hydrocarbon and do that at a very competitive cost. And we do that, we'll all do great. Our shareholders will do great. And we're big shareholders in the company, so we care. That's where we're headed.
And to put a bit of a cherry on that, speaking of shareholders, you just purchased an additional 25,000 shares of Prairie yourself. I think that sends a very positive message to investors about your confidence in the company's trajectory.
Yeah, I appreciate that. Our problem is we have very few and short windows which we can buy in. They're very fast and they come a couple of times, 2, 3 times, 4 times a year. So it's right after earnings when you've cleansed yourself. But we're so active. We have so much going on all the time that in many cases we're in possession of material information that precludes us from trading. So those little windows are short when we're buying. And you can look at whether it's me or Ed or say other people on the management team or our board of directors, they're aggressively buying too. You see all their names light up the board all the time. So they're subject to the same rules we are. When we do have a little window, we let everybody know, hey, you've got a free window here for a week, 2 weeks, whatever that amount is. And we suggest you go out and buy some shares, especially when you think you're as undervalued like we do.
Gary, in your opinion, what makes you so attractive compared to your competitors?
Yeah, that's a great question. I think it's some of the stuff that I've maybe hit on before is our lean structure, our cost structure, our lease operating expense structure, the expertise we have around our company, I think is as good or better than anybody in the basin. I'd put them up against anybody. Our takeaway capacity and what we have in our ability to get product in pipe and down the road and out of basin. We can literally contract our oil all the way to Cushing, and we produce a very high quality crude that's unique in the basin that gets blended. So we get a premium on that. We get it to Cushing, we get about a $2 a barrel premium just because of the grade and the high grade of our oil. So getting that out of basin, we get a pop there. Our transportation costs are extremely competitive. Our drill costs are lower than practically all of our peer groups. So I think there's a lot of things that differentiate us from the other guys. And I think the most unique thing about us is we are one of the very few, regardless of whether you're in the DJ or around the country, we're one of the very few growth companies. We are actually focused on growing our company and not just holding our own and limping by in the marketplace and selling off pieces or doing what. We are literally focused on growing this, both continuing A&D and through the drill bit organically. But we think we've got that process on the run. We think we have it pretty hardwired. We think we manage the state of Colorado very well, and we're very much in compliant with them, and our relationship's very good. So I think we've got a lot of positives in our quiver, and I think it probably exceeds most of our peer groups. We've got some good quality guys out there, but I think all in all, we can outperform them.
Gary, it's great to catch up with you here. I look forward to sitting down with you in Denver and perhaps the DJ in the near future. Thank you so much for joining me today in the program.
Thank you for having me, Ellis. I appreciate it. Look forward to seeing you.
I've been speaking with Gary Hanna, president of Prairie Operating Company, trading on the NASDAQ as PROP. That symbol again, PROP. To learn more about the company, visit prairieoperatingco.com. This has been the Ellis Martin Report on Money Talk Radio. I'm Ellis Martin. Thanks for listening.